Good afternoon to you both. Daryl, I'll start with you. We had a lower week for the major averages, but we did reverse higher in this trading session today, despite the weaker than expected data we've seen all week long. You a buyer or a seller of this market?
Boy, good afternoon, Morgan. Still have to be a seller here. I think the interesting thing underneath the surface, beyond the broad index, when you look at what happened this week, small caps plumbed to new lows. You had industrials roll over hard, if you look at the charts. And banks still continue to languish. Financials can't get off their back. There's no bounce there coming off the March problems. So when you look underneath the surface, the technicals and fundamentals don't look good, minus tech and discretionary.
Yeah. Tony, the R word is back in the picture. Recession, the fact that we did see this string of disappointing data, including much weaker than expected labor data ahead of that jobs report tomorrow. Are we on the precipice here of a meaningful slowdown, a possible recession when it comes to the economy?
Well, Morgan, the U.S. economy has been in a slowdown for a number of quarters now, and it does seem like it might be in what's called a growth recession. A growth recession is where it's not an outright recession, of course, below 0%, a contraction in economic activity, but below potential, which is said to be around 1.8%. A growth recession can feel like a recession with, for example, rising jobless claims, which we're seeing today, and declines in output, which we've seen 4 of the last 5 months, and a decline in retail sales, which we've also been experiencing some evidence that it may be occurring now. And so we might be in the midst of this growth recession that can be very beneficial to the bond market. It's clear in yields plunging in the last few weeks, probably on this notion.
Okay. I want to get into some of your specific ideas around the bond market. But first, Daryl, earnings start in earnest next week. Banks will be in focus. Do estimates need to come down?
Yeah, I mean, if you look right now, you've got basically top-down estimates at 210 for the S&P, bottoms-up estimates at 220. So top-down are starting to come down. They're still not low enough. We still think the year finishes around 200 to 205. It'll be interesting because what will matter this quarter is margins will matter most. And as pressure continues at that margin line, we're seeing it spill through to earnings. So earnings overall are projected to be down 7 to 8% for the quarter, basically flat revenue. But it's going to be acutely negative in places like healthcare and in some of the discretionary. The only real positives coming out of the quarter will be energy, and industrials will actually show some positive earnings growth.
Yeah, look no further than Levi's today, which got hit pretty hard, in part because of that miss on margins. Tony, I said I was going to talk about it with you. Where are you seeing opportunities in the bond market right now? How should investors be positioning themselves?
Well, clearly there's an allure to short-term interest rates. Look, they're higher than long-term interest rates. There's an inversion of the curve. But one can't be fooled entering a recession into those instruments, or shouldn't be, because they don't provide you with the total return. So a good strategy for investors is think about total return-like strategies and also income strategies that will take advantage of the potential for a recession, or it should benefit from. Specific securities, there's weakening occurring now, in part because of the idea of asset sales in the agency mortgage-backed securities market, a liquid market with good spreads relative to treasuries and swap rates. So those are good places to be. Enhanced cash strategies, as I said, these money market funds, again, can be a fool's game in the long run because you want protection, diversification, protection of safety, et cetera, by having some duration. Yeah,
I'm looking at your notes, and you say investors are fortunate that there is a playbook for the late cycle dynamics that are now underway. So it sounds like you just laid some of that out. Daryl, I want to get your thoughts on this. How are you advising clients to be positioned in this market, given all of the uncertainty right now?
Well, I think Tony's right on the bond market. So right now we would be barbelling the bond market. So in other words, we'd have our exposure on the short side of the curve and on the long side of the curve, and basically hollow out what's called the belly, or the intermediate section of the curve. We don't find a lot of value there. We still think it's way too early, though, Morgan, to go down the credit stack or lower your credit quality exposure. High yield spreads this morning are about 480 basis points over. You've got to get those numbers upward closer to 657, 750 in our humble opinion before things really look attractive there. And if history is any guide, recessionary indicators and pressures will push them there before it's said and done. So too early on credit, and barbell your duration exposure between short and long.
Okay. Gentlemen, thanks for kicking off the hour with me.
Thanks, Morgan.
Daryl Cronk and Tony Crescenzi. Have a great long weekend.
You too.
Wall Street is on alert for the March jobs report that's coming out tomorrow morning. CNBC senior markets commentator